All right, Nash, you start us off while I figure out the audio because I can't.
All right. While you're breaking technology over there, I'll get us started. Thank you, Matt. This is the Monday Monday Mortgage Update, Monday Market Update. This is why Matt does this first. I'm thinking about Matt, the mortgage guy, Gougé. I'm Nash Paradise, your loan wizard. And we're going to dive right in talking about what's been happening, what's going forward, and what to expect. This is a fun one. So we love coming back from an extended break here. We had Labor Day off, and that was wonderful. I hope everyone had a relaxing time. If you're in the real estate market, last week was probably anything but relaxing, but finally for good reason. So taking a look at last week's economic data, it was all about jobs. Wednesday, we had jobs numbers from JOLTS. Those are the job quits, job starts. Thursday, we had jobless claims, ADP jobs numbers, and continued claims. Little soft. And then Friday was the big stuff. Unemployment rate, non-farm payrolls. Non-farm payrolls came in way light. This is the big ticket item. This is the big news stuff. This is where we've had massive revisions. It's cost, head of the Bureau of Labor Statistics, their job. This is huge. We had a 75,000 jobs added forecast, came in at 22,000. The economy is slowing. Jobs are being added much slower. These revisions are not going well, depending on your perspective. For mortgage people in real estate, it's good for us. A slowing economy is good for lowering interest rates. When the economy is booming and bustling and things are getting added, inflation is flying, we're going to have high interest rates and things are going to stay there. So last week was a phenomenal week as far as econ data as it relates to mortgage and real estate. Let's talk about what's going on this week, because again, lots of movement last week. Every single day, it seemed like we had something. And this week is interesting because we've really just got one big day here, and that's going to be Thursday. So if you're circling a day on the calendar, Thursday is that day. We got the inflation numbers. Month over month CPI for August and year over year CPI. We've got the core figures as well as headline. So nothing that's really jumping out to me other than the forecast headline. That was 2.7% last month. It's forecasted at 2.9%. So they're anticipating inflation to go up on the headline, but then the core, which excludes energy and housing, that is flat at 3.1%. So kind of interesting seeing the mixed bag on forecast there. Tells me we may have mixed data coming in as well. And if that happens, then we should probably just hold the line. The 10-year Treasury bond has been going down pretty handedly. Mortgage rates have been improving a bit. So good for what we're looking at on that side. Nothing to be terrified of, but big numbers coming out Thursday. Let's take a look at what that means for our numbers here. So Matt, if your microphone is working, this is a wild stair step from what we saw 2 weeks ago. Why don't you interpret this for us a bit?
Yeah, sorry about the technical issues. For whatever reason.
Lost you again. Still no microphone.
No, you can't hear me? Microphone?
It's all right. You just smile and look pretty.
You really can't hear me?
Really can't. Coming in, cutting in and out.
Come on, man.
I know, but you're good looking, so I'm not mad to look at your face. So what we're seeing here right now, the Fed funds rate, 450.
Oh, now.
That 425 to 450. Still now. We are going to have a Fed rate drop in September. That is certain. 88.1% that we have 11.9% that we get a double drop in September. I don't think it's going to happen. That's right around the corner. But what's interesting about this, we're now forecasting 3 interest rate drops. One in September, one in October, one in December, with an 83.6% certainty. That's really, really big. We are definitely expecting these drops to come. 3 through the end of the year is great. And then looking forward, just because this is interesting, we try not to project too much, but we just got drop after drop after drop. Another one in first quarter with a 99% certainty. Another one in second quarter, and another one as we get to the tail end of third quarter, early fourth quarter. It's going to happen as well. So it's 1, 2, 3, 4, 5, 6 rate drops between now and September are projected over the next 12 months. I mean, that's huge. That's really important direction. It's going to move the needle a lot. And getting all the way down to that, 3.0 from 4.5, it's healthy. That's where we should be. Everything can change in between now and then. But the one thing that's not changing is we're going to have a drop in September. Enough data is out. That's going to happen. Let's jump into why you're really here, which is what's happened to mortgage rates. And oh my.
Yeah, hopefully my mic works now. I just went connect to computer. Not great mic, but it's working now.
It's weird. It is like you're at double speed. It's like Turbo Matt coming through.
What is going on? Well, I'll just sit here and look pretty then.
I don't know. I can tell what you're saying, but yeah, it's like it's been sped up 2 times. It's all right. This is easy day. This is easy good news. So even I can handle this. Looking at this chart here, we were hovering and teasing that 6.5% threshold, and then boom, bottom fell out in the last week. All the way down. Let's see what the numbers are saying. Yeah, 6.29, 6.31, 6.28. We are way low on the overnight average. Now, I will say the one kind of problem with this, like the 6.29 overnight average, is this is a composite that takes a lot of different things into account. And this is getting out there on the news. This is being shared with real estate agents. We're not seeing most clients getting a 6.29. Now, on refis, yeah, we are. That's priced a little bit better, especially when you have some equity. Your average 20% down, 740 credit score, probably not going to be at that 629 mark. It's more, around the mid sixes right now, which is still a fantastic spot compared to where we have been. But, I've been telling people that the overnight average interest rate is a lot like Credit Karma. You're not using it to tell you your exact credit score. You're using it to check for trends. Where are things going? Right now, things are headed down. They're headed in the right direction. And because we opened up today, still on that same trajectory, there's no reason to believe that trajectory is going to slow down. The bond traders are going to abandon the 10-year. They've been very good and aggressive about pumping that price up, which is dropping that yield. We're still teasing above that 4% floor. I think last I looked, it was like 4.09. So getting through that 4.0 floor is what will open up a new mortgage-backed security, which is nerd speak for, jumping into a different tranche and being secured to the 5.0 UMBS instead of 5.5. What does that mean for normal people? Not much. It just means that things are getting better and they're getting better in the right direction. Matt, anything you'd like to add to that now that you got a new setup over here?
Well, yeah, I mean, I'm on my phone now and I don't know, I leave Friday, everything's hooked up correctly. I come in Monday morning and nothing changed. But rates are a change, and I know that. So, I'm curious to talk to you because you and I both, have the data that we see, and then you have the conversation with clients and what you're kind of feeling and seeing on the street, if you will. So I know you're having refinance conversations. I'm having plenty of refinance conversations. With everything you see on the data side, because you follow the stuff closer than I do, to be quite honest, all the economic news that's coming and the things that may or may not affect rates in the future. What's the sentiment for buyers who are like, oh man, I'm really close. I can get a 6.125 right now, but maybe because of the cost, it doesn't make sense yet. Are you getting people plugged in and floating? Are you having people say, like, here's the strike rate and the price associated with that strike rate, and let's go when we hit that? I'd be curious to know what you're doing, because I know you do it at a high level.
So I have been having lots of refinance conversations. I locked in 7 of them last week. It makes a lot of sense for a lot of people. And, when it makes sense, we make sense of it and just go. Trying not to overthink it too much. Every time we've had one of these rate rallies in the last few years, it's been very, very short lived. This one is the longest one by far. So I'm awesome taking that as a win. The unique position of being a mortgage broker in this market is, if we're going in one direction and, rates significantly improve over 2 to 3 weeks, we can switch lenders. That's just part of the reality of the flexibility of a mortgage broker. So knowing that if I've got what I like and the math makes sense, then I lean into the math. It's just costs divided by savings equals recoup. And we're getting a lot of stuff at 6 to 10 months recoup time, some of them 12 to 14. But one of the interesting things is we're doing a lot of shorter terms. The deeper you dive into how amortization works, you really learn that 30-year fixed mortgage is a matter of necessity, not design. It's not a great product for a lot of people. If we can take these smaller loan amounts, which you don't see, Matt, in California, but when you got people that have paid down their loan or they've been in it for a bit, or here in Texas, I got lots of people that have financed less than $300K, looking at 20-year loans for them. I mean, we're talking about saving, $100,000 in interest over term on something like that. So we're getting a little creative to make things make sense. I'm also talking to a lot of people where it's just like, yeah, you bought at 6.5, 6.6. It doesn't make sense to take action right now. But, we'll see what the next 3 months, 6 months, 9 months look like. And so we're going to lean into those people, around 7% or over that, find the wins, take the savings. We don't know where things are going to go. We do know the last couple Fed rate cuts were not necessarily kind to mortgage interest rates. And having done this for 19 years, I've been through every refi cycle we've had in the last 2 decades. I know that when it looks good and makes sense, you just take action and you don't worry about, watching the price after you lock something in.
Yeah, I agree. And you brought up a really good point. I've had at least 2 conversations with people that are looking at a 15-year, and it is wild for somebody who likes math. And I know you like math like I do. It's crazy to see how you go from 7% on a 30-year, to 5.25 on a 15. And like the conversations I've had around that is, if you can afford to pay this payment, which is going to be more, you think about paying the thing off in half the time, the payment's going to be more. In a specific client's case, they've got a home they sold, so they're able to throw a couple $100,000 at the principal. So they're actually going to go to 15 years, lower their payment, and save some crazy number like $236,000 in interest, because like you said, the amortization schedule on a 30-year, unfortunately, you're just not paying a lot towards principal on the, first decade of that mortgage, especially at today's rates. But you shorten that thing to 180 months instead of 360. Now all of a sudden you've got $1,000, $1,200, $1,500 a month chunking off that principal, as opposed to the 236 or the 275 you start with on the 30. So yeah, it's good to look at all your options, and it's good to be able to have a mortgage broker who at least thinks to ask those type of questions. What are your goals? Are you trying to get this thing, paid off before your 60th birthday because you want to be, in a position to have a mortgage-free retirement? Are you trying to, just make sure that you survive on cash flow and don't add, credit card debt? You need the 30 probably. There's a bunch of different angles to take. And so, as rates fall and the conversations start becoming more frequent, I guess my public service announcement is just make sure you're talking to a knowledgeable mortgage broker, somebody like Nash Paradise who's been doing it for 2 decades.
Well, and if you haven't been doing it for 2 decades and, you're one of our people watching this, understand that borrowers don't know. The impression, if you were to ask someone like, well, hey, what's your payment right now? $3,000 a month. Okay, what's that payment on a 15-year? I don't know, $5,000, 55. People have no idea what the math looks like. I've got a lot of people, because their escrows are so high, we're talking about adding $500 a month, going from $3,000 to $3,500. Now they're on a 15. Like, really? Because that percentage of their mortgage payment, so little of it is the actual mortgage payment. It's a lot of taxes and insurance. They just don't realize that, dropping this term is not a 1-for-1. It's not even a 2-for-1. Like, it's a much lower amount. So giving people options, when you look through and take that full application, understand their income, understand their assets, you see where they are with their debts. You need to be an expert, and an expert looks at all these things and they paint a picture, and it says, hey, this person could afford a few extra $100 a month. Let me show them, that mid fives 15 versus what they're looking at right now. Show them how much it saves them. We got to start thinking about these mortgages less as your home where you're living and more as a financial vehicle, as an instrument for the long-term net wealth. That's going to put you in a different position. You're having different conversations, and these things don't really occur on a lot of purchases. It's going to get the house. Do you like the payment? Affordability has been so rough the last few years. We haven't really had these conversations in this same way. But now when you're asking the right questions, looking at the full picture, you can give some much better insight as to what someone may consider doing and talk to them more as the expert consultant instead of that, solve for X, you want to save some money, here's how much money you can save kind of thing.
Great stuff, man. Great stuff. I appreciate you as always. Any parting words, or are we getting out of here?
No, I think that's the parting thought is do the extra work. Don't assume you know what someone wants or needs. I've had a couple conversations with loan officers who actually lost business in the last week or two because they didn't think the cost versus the savings made sense. They didn't go deep enough with the clients to realize that, oh yeah, saving $280 a month really changes their month over month basis to such a significant degree that they didn't mind rolling in $7,000 in costs. The loan officers are just like, yeah, no, this is not a good recoup. And they end up refining somewhere else for even more money. So like, don't assume, ask the questions, get the information. And I know we're all excited to pitch these, work them up, and tell people how much money we can save, but pump the brakes just a bit and have a better understanding of someone's situation. You're going to come up with better solutions.
Agreed, man. Thanks, brother. We'll see you next week. I'm going to call my tech guy now. Figure out what's going on over here. Thanks, buddy.